Well, I've been talking about material information, material non-public information, insiders, etc. You can see previous discussions if you follow these links here. Today, I want to talk about blackout periods for insiders. Before we get there, just as a refresher, material information is any kind of information that would affect the price of a stock. So any kind of information that a reasonable investor would think is important in terms of evaluating a potential investment. Now, some companies impose blackout periods. So blackout period is a period of time between this date and that date where you're not allowed to trade. Now, these blackout periods typically only apply to certain employees, not all employees, and those employees during this window are prohibited from buying or selling shares of securities associated with that company. Now, this typically happens, as most commonly occurs, prior to earnings announcements. So during the weeks leading up to a quarterly earnings announcement, the company will impose a blackout period. Now, an interesting point here is that this is voluntary, right? In fact, there are no rules mandated by the SEC saying that a company must put in place a blackout period prior to an earnings release. That's right. The SEC doesn't care if you trade during the weeks leading up to the earnings announcements. What they care about is whether or not you're trading a material non-public information. That is the rule, but there are absolutely no rules in terms of mandating a blackout period. Now, I know you're thinking, Brian, that's crazy. What about this? And there should totally be a blackout period regarding this. And what about that? Yes, you're right. It is crazy. There are no mandated blackout periods. Next time, we're going to talk about some crazy examples of when there aren't blackout periods and no disclosures at the same time. So it's totally crazy, but that's how it is. Thanks so much for listening.